You gotta be flipping my flapjacks. I have 65 slides ready for you guys, and this beast of a video is taking me hours and hours and hours to prepare this one, and we've got a lot to go through in this video here today, okay? It has been quite a 3-year ride, and for anybody that's been with me on this 3-year ride, it's been a lot of fun, right? You know, 3 years ago, public count just over $1 million, and to see that at nearly 4.2 million right now is pretty shocking. I mean, honestly, if you asked me 3 years ago where the public count would be at, I wouldn't have said 4 million. I probably would have said 2. I maybe would have said 3, but certainly not 4. It's been quite unbelievable, right? But here we go. We might have some weakness. Okay, Cheesecake Factory down over 7 percentage points here today. I'm now up $31,000 on that stock. That does not include dividends, but that was a $12,000 hit here today. Adobe, a new stock of mine, down 6+% here today, right? That stock has started out at about a 4% down position. I had $1.2 million riding into Meta earnings in the public account, and look at this, Meta down 7 percentage points. So the indestructible Jeremy is now looking a little like the armor, right? I used fancy AI to create this image. The armor is kind of falling off here, and we're like, oh, what's going on here? Uh-oh, like, is this ride about over, right? Meanwhile, we have the other side of things. Google, a somewhat newer position for me, has been doing so well. Up $52,000 on the stock. And guess what? It's up more after hours here today. Fubo got great news here today. This is a speculative stock I own, made about $28,000 on so far in the public count. Got great news in regards to that stock here today. Palantir's on a generational run. Like, you want to see a generational run, look at Palantir stock the past 3 years. This is a truly generational run. I mean, 3 years ago, you get this stock at $6, $7, $8, right? And today, it almost touched $200 a share. Somebody in the comments keeps saying that nvidia and Palantir both have to go over 200, and then we're going to have the stock market crash. So we'll see what happens with that, okay? In this beast video here today, 8 subjects to go through. J. Powell. We got to talk about Jerome Powell quickly at the front here, what this means for the market and where we're headed from here. The 2 big things did happen that not a lot of people are talking about that I got to explain, okay? Then we're getting to Cheesecake. What's going on there, where that stock's headed? Adobe. What's going on there, where is that stock headed? Meta. What's going on there, where is that stock headed? Google. What's going on there, where is that stock headed? Fubo, what's going on there? Where is that stock headed? Then we're getting to 2 stocks I bought here today. I put a little over $7,000 in each of them, so we can call it around a $14,000, $15,000 move. Talk about what stocks those are, why I did it, and then we'll get into Palantirs in this video. I hope you guys enjoy this beast, man. It is so busy for me every single day right now. The only thing I need from you guys is just smash a like button. That's if you could just do that for me. I mean, the amount of earnings coming out, trying to listen to these conference calls, grade these income statements, right? Record the private stock group video today. It's just ridiculous. So I appreciate you. All I need from you is just smash that like button, make that like button glow. That's all I need from you. If you want to be subscribed to the channel because you want to see more of my videos in the future, make sure you're subscribed here to the channel. We are now over 900,000 subscribers. Incredible, man. Absolutely incredible. And yeah, I think we just hit that yesterday, I want to say. So thank you, every single person that subscribed here to the channel, okay? Additionally, pinned comment down there here today will be if you're looking to apply to join my private stock group, private wealth group. Demand is ridiculous. Out of control, ridiculous to join us in there. We're now up to 2,717 members. We had another 6 members join before I even woke up today. It's been out of control. Just yesterday, I had to count it up. I'm like, how many people applied to join the private group yesterday? 126 people applied to join the private stock group yesterday. To put that in like context, 15 to 25 usually apply on a normal day. 126. It's so ridiculous. My guys are so busy right now that literally I'm thinking about potentially closing the private stock group to new members in either November and December. It's out of control right now. When you join us in there, we will send you your Steel membership cards. That's access to all my course curriculums, a Discord chat, exclusive weekly videos like the one I recorded today, access to see all the moves I'm making, my $4 million plus Fidelity account. That will be pinned comment down there to join us in there before I might close it down to new members because this is ridiculous. Alrighty, guys, let's get into J. Powell here off the top. Listen, they lowered the Fed funds rate. No surprise, but few very important things did happen, okay, that matters significantly in market. In addition to the rate move, the Fed announced that it would be ending the reduction of its asset purchases, a process known as quantitative tightening, on December 1st. Now, that sounds like a little confusing. That sounds like, is this going to be anti-market or how does this work, right? Remember, quantitative tightening is a monetary policy where a central bank reduces the amount of money in the economy primarily by letting go of holdings of government bonds, securities. So it's basically shrinking of the balance sheet, okay, is the best way I can put it. And that's usually bearish for the stock market. You could look at it as also bearish for the economy. If the Federal Reserve is actually shrinking their balance sheet at a particular time, you could say, oh, that might lead to problems down the road. Now, when they start quantitative tightening, it's usually because the economy is like too hot. It's too good out there. So it's usually like things are too good, so we need to start quantitative tightening. We need to bring down the balance sheet, right? Which then ends up actually hurting potentially the economy and those sorts of things, right? This is ending now at this point in time, right? Which then sets you up for what's called quantitative easing. Now, there's no promises of quantitative easing coming, but when you end quantitative tightening, which is ending in December, that sets you up to then, if let's say the economy or something goes off the rails, a lot more job losses, let's say in 2026, right? Fed can lower rates even faster and then start quantitative easing, and they could do things like actually start to purchase assets again for the balance sheet and actually increase the balance sheet, right? If you look from the peak of 2022, where the Fed balance sheet peaked right here, about $9 trillion, the Fed's brought that down by over $2.5 trillion, right, from that 2022 peak, which is crazy. And you know, the fact that the market hasn't crashed is pretty shocking. A lot of people expected, if you would have told people, honestly, 3 years ago, the Federal Reserve is going to bring down that Fed balance sheet $2.5 trillion, what do you think is going to happen in the market? I think almost every Wall Streeter, every economist would have said the market's going to crash in the next few years. They can't bring that down $2.5 trillion. We're not going to be able to withstand that. Guess what? They did it. And stock market's actually, all-time highs it hit here today? Like, it's unbelievable, right? Now, another very impactful thing that happened is, did you see what happened with the 10-year today? The 10-year Treasury spiked higher, which is pretty shocking. Like, this is a huge move for the 10-year, like a huge spike up there. It was in the threes. And so keep this in mind. If the 10-year goes higher, mortgage rates likely go higher. 10-year matters significantly to mortgage rates, in which means at the end of the day, like, that means the real estate market could be even more dead than it's already at, right? Now, keep in mind the Fed could do some things in 2026 to potentially bring down the mortgage rates overall, even if they can't really bring down that 10-year. The Fed can influence mortgage rates by buying specific assets, such as mortgage-backed securities, to lower their yields and thus mortgage rates, right? They did that back in 2020, 2021. So keep in mind, the Fed has some other cards up their sleeve to bring those mortgage rates down. We know T-Man wants mortgage rates down, right? So we'll see what happens with that. I'm going to sign my name on a mortgage next year at some point in time. I would love them to bring mortgage rates down, right? That was just, I can't complain about that. But we'll see. We'll see what happens with all that, okay? Cake, next up here. What's going on with cake? All those sorts of things, right? Listen, Cheesecake's a huge buy right now. The stock's trading at a forward P of 14, which basically is telling you the company's got no growth. Like, it's like, you know, just a profit machine, ATM, but it's kind of a dead company, right? They're not even trading at a market multiple. They're trading significantly under a market multiple right now, right? But check this out. I posted this inside the private stock group. You got to dig deeper into the transcripts of these conference calls to get the data, because they actually didn't post this data, okay? You got to listen to a conference call or look at the transcript, which I looked at 1000xstocks.com, okay? Flower Child revenue grew 31% in the quarter. Remember, that's one of the key businesses I'm talking about, is like a growth engine for the company for the next 5-10 years. 31% revenue growth. North Italia, the other one I keep talking about, if you've listened to me talk about Cheesecake for the last few years, right? What's the other brand I talk about? North Italia. That grew revenue 16% in the quarter. So those two businesses are growing substantially, and that's not going to stop anytime soon. Like, the next 5 to 10 years, you're going to see significant revenue growth from those two brands. And remember, the base is getting bigger for those two brands. The raw revenue numbers is getting bigger, which is going to ultimately help the revenue of the overall company actually accelerate substantially in 26, 27, 28, and beyond. So that's something important to keep in mind there, right? A private stock group member asked about comps for the quarter, because comps, you know, for Cheesecake, they weren't horrible, but they didn't look good for you know, the different brands at Cheesecake, right? And they're asking, you know, do I think there's something wrong with Cheesecake, or do I think it's more industry-wide? And I said, I think it's, you know, weakness in the industry overall in the restaurant category, right? I think the whole category looks rough at the moment. I said, I'm going to keep a close eye on Chipotle earnings to see their comp store sales. Well, guess who came out with earnings after the bell here today? Is it Chipotle? And guess what happened? Chipotle reported a miss on their same store sales, but it gets even worse than that. Look at this. Chipotle was expecting the overall year same-store sales to be flat, which is already a disaster for Chipotle, right? They should be always growing their same-store sales. Now they're talking about low single-digit decline. That means they're going to be doing less business in each one of their restaurants than they did in the previous year. Like, we've never really seen this outside of what? Maybe when they had the whole health scare situation years ago, right? That's insane. Absolutely insane for Chipotle to be in that sort of situation, right? And if you've been following my content for a while, what's the one stock I used to hate on all the time back in 2024? I was so bearish on the stock, and anytime I got a chance, I took jabs at it, and I told you guys it was going to get ugly for this company. It was Chipotle. And that was back when this was like a $60 stock, right? And I would talk about they've been making so many missteps in the company. I talked about the CEO's leaving the company. That's not a good sign. The fact that he's leaving to go to Starbucks, another messy company, like that means this ship is going down, right? This is a Titanic. And when I say this Titanic, it doesn't mean that they're going bankrupt. That doesn't mean they're going out of business. It's just the stock was destined to have a massive downtrend. And that's what's going on here now. And now basically everybody that's bought Chipotle in the last several years is now down substantially, and you could get tax loss selling into the end of the year. It's an ugly situation in regards to Chipotle, and I called that out years ago, right? Now, in regards to cake, to bring it back to cake, why am I so excited about this stock? The stock's a huge moneymaker for me over the next few years. Check this out. I ran them at only 7% revenue growth on average, 2026 to 2029. Very doable number given the growth of Flower Child, given the growth of North Italia. That's no problem at all. I did them net income growth at 9%. Those two concepts should make them much more profitable, right? And a lot of that should head down the bottom line. We're seeing continuation in that EPS growing very nicely for the company year over year, right? Net income as well, right? Income from operations. So I think 9% net income growth on average per year, 2026, 2029, is not a crazy number at all. This still has them at net income margins in the 5% range, right? If you're growing high single digit revenue, high single digit, we can call it net income, right? For a company that has this much growth over the coming years in several concepts that are successful, I think a 25 to 30p is fair for a company like this, right? With those sorts of growth rates. We're talking about a CAGR that's mid-20s, maybe all the way up to 30% range over the next few years, right? We're talking about a stock that goes to 125 to 150 come 2029. I'm going to buy it. Like, it's just a steal deal, right? Steal deal overall for this company. But even look at my bear case. My bear case has revenue growth of only 5%. That'd be horrible. Net income growth of only 5% per year, 2026, 2029. Disaster, right? Remember, they should grow revenue 2 to 3% a year just based upon inflation, right? You always got 2 to 3% inflation pretty much out there, so your pricing on your menu is going to go up 2 to 3% pretty much every year to offset that cost, right? So 5% with all the growth in North Italia and Flower Child and their other concepts as well. And remember, they're still actually growing Cheesecake Factory locations as well. Whoa, this would be bad. This is very bearish, okay? 5%, 14 to 19 PE, right? Significantly under a market multiple. And I still get a CAGR of 5 to 13%. I got to take that. I got to take that every single time. So Cheesecake's a buy. It's a buy. And guess what it is? It's a buy, okay? Next up here, Adobe. What's going on here? Where's the stock headed? Well, they got a multitude of bad news. Adobe launches AI assistance for Express and Photoshop. Adobe now lets you generate soundtracks in speech in Firefly. Adobe to release AI-powered video editing system, Project Frame Forward. Wait a minute. Okay, that wasn't the bad news. Okay, here's the bad news. Adobe stock is down despite analyst praise. Okay, wait a minute. Adobe CEO says the stock is undervalued. Okay, wait, that wasn't the bad news. Okay, here's the bad news. Adobe announces YouTube Shorts creation tool in Premiere. YouTube Shorts will integrate Adobe's Premiere video editing tools. Wait a minute. Okay, that's not the bad news. Okay, here's the bad news. Adobe might have just solved one of generative AI's biggest legal risks. Shoot. Oh, there's no bad news in regards to Adobe. It's the same fear-mongering stuff that we hear quarter after quarter after quarter. They're going through this same exact thing that guess who just went through this whole cycle? Google McDougal. Google McDougal just went through this whole cycle. And now everybody doesn't care about all the fear anymore, right? Because Google just kept coming in and putting up their numbers and putting up their numbers. And so all Adobe has to do is just come in, put up your numbers, quarter in and quarter out, and guess what? People are going to love your stock. They're going to finally get off this like bearishness that they've been stuck on here in regards to Adobe, right? So Adobe, here are my numbers for Adobe. These are not crazy numbers. This is my bull case. 10% revenue growth, 12% net income growth, 25 to 30p. It's kind of a SaaS play, recurring revenue business model, like beautiful business model, right? Asset light. Get a 20+% CAGR in that sort of scenario. My base case for Adobe has an 8% revenue growth, 10% net income growth, not crazy numbers, 23 to 28 P, 15 to 21 CAGR on this stock. Like, you know what, like, it's a buy. You know what I mean? Like, it's not the most complicated thing in the world. And remember, with my numbers, I haven't even factored in if they actually are a huge beneficiary of AI. My numbers are factored in that, if anything, AI is a little disruptive to certain practices or business models, so it hurts growth rates a little bit. That's what my numbers are based on. And like, we don't know, like, with how much Adobe is innovating here, like, they don't just have all that team there for nothing. Like, maybe AI is actually a beneficiary. Maybe they start growing 12% revenues, 15% revenues, 20% revenues. We don't even have that in the numbers. Do you know what the CAGR will be if that happens? We're talking 30 and 40% CAGRs if that happens. So that's not what I have, but even with my sleepy, boring numbers, it still should be a huge moneymaker over the next few years. Okay. Oh boy, Adobe. Okay. Meta. Okay. Big dog. Okay. Here we go. Meta, the big dog. Okay. Alrighty. So first off, Meta, great revenue growth from this company. Look at this. Look at this. Revenue growth went from $40.5 billion to $51.2 billion, right? Cost of revenues increased for the company like you would expect to $9.2 billion from $7.3 billion. R&D was up a lot. It's a $4 billion move. I mean, run that on a percentage basis and you should be, somewhere in the, that would be what, a 35% growth number, somewhere around there roughly. As far as R&D, it's a huge increase in R&D, right? Marketing and sales basically flat year over year. That's unreal. The fact that this company grew their revenue by close to $11 billion, what, $10.7 billion or so, and marketing sales was flat, legendary. Like, that was something you for previous business models, you never would have thought that was possible. G&A was a problem for the company. G&A basically doubled year over year, so that was a big increase there, right? So total costs and expenses went to $30.7 billion from $23.2. So expenses were a little high, right? And so if there's one thing you want to poke at for Meta, it's Zuckerberg might be going a little too aggressive with the expenses, right? We want to see expenses growing less fast than revenues, right? So income from operations still increased nicely to $20.5 billion from $17.3. Income before income taxes went to $21.6 billion from $17.8 billion. Now, they had this one-off here, this provision for income taxes. This was a one-off, massive, almost $19 billion hit, which killed their GAAP EPS. But if you look at their non-GAAP and you take out that one-off, like, it was phenomenal. So that's why I graded them a B- overall for this income statement here. Now, look at this. This is very important for all the longs that are in this stock for the next several years. We expect a significant reduction in our U.S. federal cash tax payment for the remainder of 2025 and future years due to the implementation of the One Big Beautiful Bill Act. So, tax is going to get a lot more favorable for Meta over the next few years, okay? However, the implementation also led to the recognition of a valuation allowance against our U.S. federal deferred tax assets, reflecting the impact of the U.S. corporate alternative minimum tax. As a result, the third quarter 2025 provision for income taxes includes a one-time non-cash income tax charge. Non-cash income tax charge. It's very key, okay? Of about $16 billion. Excluding this one-time tax charge, our third quarter numbers effective tax rate would have decreased 73 percentage points. Net income would have increased by $15.9 billion to $18.6 billion, and diluted EPS would have been $7.25 instead of the diluted EPS of $1.05. Okay, so the moral of the story is here: tax is going to be a huge help for Meta from now on. But they had to take this one very large non-cash income tax charge of about $16 billion, okay? That's very important, very important. Now, this was kind of shocking to me. Daily active people, so this is, people using all the different apps. They have Facebook, they have WhatsApp, they have Threads, they have Instagram, all these different products, Messenger. That actually increased 8%. Like, every time you think, like, there's no way Meta can grow the amount of people using their service. They do it. I don't know how they do it, but they do it, man. And sooner or later, I think all 8 billion people on the planet are going to like be signed up for at least one of Meta's apps and use it on a daily basis. It's shocking. Ad impressions increased 14% year over year. Average price per ad went up 10% year over year. So basically they're showing more ads. People are likely using the products more often, so they're getting to show more ads. And then what they're being able to charge advertisers is a much increased amount as well, which keep in mind that's very important. Meta's spending a lot right now to basically get their get people to spend more time on their platforms, right? And show them content and stuff that'll keep them on the platform longer. That's how AI is helping them make more money. The second part is, right, so they can show them more ads. The second part is Meta wants to essentially be able to charge the advertisers more and more money. How can you charge advertisers more and more money over time? Guess how? By making them more money. So they're using AI to hopefully show the right people these ads so companies can make more money off of those ads and get a better ROI on those ads, right? If they get a better ROI, those companies have more advertising budget to then spend with Meta and funnel it right back in. So if you're wondering, how is Meta like actually making money right now from AI and can continue to for the next year or two? Oh, let's not talk about what they could be doing with AI and how they could make money from that 3, 5, 10 years from now. What about right now and what about next year? Keep people on the platform longer because you're showing them stuff they actually want to see, right? And keep them engaged in the platform. And 2, have your companies make more money so they can spend that right back with you, right? And you're going to be able to charge even more for ads. Very, very key, okay? Now, revenue went to $51.24 billion. That's a 26% increase, which is shocking, man, shocking. Now, this is the one issue I would point at Meta. Total costs and expenses was up 32% year over year. So that's the one thing I'm like, okay, Zuck, we're going a little heavy on the expenses here. Let's chill, right? I really want to see Meta be in a situation where they're growing revenues at a faster clip than expenses, right? I do not like to see those expenses rising faster than revenue. I'd say, if costs and expenses were up 20% year over year, or even 25%, I would say, okay, that's fine, right? Because the revenue number is a lot bigger than the expense number. So keep in mind, even if the percentages were the same, like let's say revenue was up 26% and expenses were up 26%, the raw number would be way dramatically bigger for revenue because 26% of 51 billion is a lot more than 26% of 30 billion, right? It's just math. So that's the one issue. I don't like that the percentage is so much higher here, okay? So yeah, Zuck, we got to get that fixed over this next year or two. Now, additionally, you think about that revenue growth rate of 26%, they're growing faster than anybody in the space when it comes to Mag 7 except one company, and that's, guess who? These guys right here, nvidia, right? So Meta's the king. Can't call them the king. Well, nvidia is still the king of growth when it comes to Mag 7. They're the number 2 when it comes to Mag 7. So if you want exposure to Mag 7 and you want big growth, you know who to go to if you don't want to go to nvidia. And I understand there's a lot of fear about nvidia because like numbers might peak in the next year or two or things like that, right? With Meta, if anything, they're showing accelerating growth and they show consistency in growth, right? And so if you want growth and you want Mag 7, there's one stock you go to, and that is Meta. Now, when it comes to Meta, here are my numbers, my bull case, base case, and bear case for this stock. This stock is a steal deal buy right now, okay? On my bull case, I haven't grown revenues 20%. Keep in mind, the company just grew revenue 26%. So even in my bull case, I have them growing revenue significantly under what they've been putting up. Keep that in mind, okay? I like to do my numbers a little more conservative. This is my bull case. I'm doing 22% net income growth on average per year, 2026 to 2029. Getting a 39% net income margins, 35 to 45p would be very fair for a company growing 20%. Top line, 22% bottom line, right? That would put the stock somewhere between about a $2,200 stock and about a $2,800 stock come 2029. My base case, this is what I expect for Meta, okay? 15% revenue growth. They just grew revenue 26%. I have them growing 1,100 basis points lower in my base case than what they just grew in that quarter. Talk about being conservative. 15% revenue growth per year, 18% net income growth per year, 2026 to 2029, 29 to 34 PE for this stock, right? And look what we get. We get a CAGR that's well into the 20s for this company with those, in my opinion, very conservative numbers. How are you not buying Meta right now? You got it. Like, do you like money? You like free money? You like free money on Meta stock. You don't like free money, don't own it, right? The stock, in my opinion, is going to $1,000 plus next year in 2026, right? Bear case, my bear case for Meta. This would be bad. 10% revenue growth? Disaster. All this money spent on AI and they only get 10% revenue growth per year? Disaster. Net income growth, 10%? All this efficiency they should be getting from AI over the next 4 years and they only average 10% net income growth? Disaster. Okay, got a company growing 10% top line, 10% bottom line, 23 to 28 PE is what you're going to pay for that stock. Guess what? I still get a 6% to 12% CAGR on the stock. And that's under a disaster scenario. When I can run my numbers and get performance that's likely going to be better than the S&P 500 in a disaster, give me every share you got. Listen, say thank you. Say thank you to the algorithms, the algos, okay? Because as soon as those numbers came out, the stock went down 7%. Like literally within minutes of the numbers coming out, it was already down 7%. This was not humans deciding to sell Meta stock off. It was instant. As soon as that EPS hit from the one-time tax hit there, non-cash tax hit, right? As soon as that happened, the stock was down 7%. It was like, boom, right away, right? So say thank you to the algos for this move down if you're somebody that's been looking to build a position in Meta, because that's incredible, man. Like, you just got gifted. That's the best way I can put it, okay? Next up here, Google, McDougal. Then we'll get into Fubo. Then we'll get into two stocks I bought, $7,000 a piece. I put in those today. Then we'll get into Palantirs. Google McDougal, B plus income statement here. Revenues went to $102 billion from $88 billion. Very nice revenue growth from Google. Like a lot of people thought Google wouldn't even be able to grow double digits. Now they're growing at mid double digits revenue. Very impressive, Google McDougal. Cost of revenues went to $41.3 billion from $36.4 billion. R&D also a little bit of an issue for Google. So these companies are spending, their spending's getting close to like a little out of hand, right? R&D $15 billion from $12.4 billion. G&A also an issue for Google McDougal, $7.3 billion from $3.5 billion. Total costs and expenses went up to $71 billion from $59.7 billion. Income from operations went to $31.2 billion from $28.5 billion. If we look at income before income taxes, because they had a big other income here, it's kind of more of a one-off situation. $43 billion versus $31 billion. Net income almost $35 billion versus $26 billion same quarter last year. But once again, that big kind of one-off really helped there. The income from operations increase wasn't nearly as impressive as you would have expected, right? Because basically 10%, if their income from operations was up 10%, that would be $2.8 billion. And that's roughly what they were up there, right? So we can call it income from operations look like it didn't even grow as fast as revenues grow. So that's why I graded them a B plus and not into the A grades, right? So that's Google McDougal here. Now, the important thing to understand about Google is they're actually accelerating growth quarter after quarter after quarter right now, right? Look at this. They went from 11% revenue growth to 12% to 13%. In this latest quarter, 16% revenue growth. Bravo to Google McDougal on continuing to accelerate growth. Like I said, the whole story about, Google's dead, they're done, AI disruption, that was the talk. I mean, it's that talk started in 2023 and was really ferocious for Google in 2024 and into the beginning of this year. And at the end of the day, look at the numbers. The numbers are phenomenal. And keep in mind, this quarter, they just put up that 16% growth. That was coming off of last year's quarter. They grew revenue 15%. Very impressive, Google McDougal. They're doing a dang good job here, right? Now, as far as what are my bull case, base case, bear case for Google stock, well, my bull case has them, guess what? Growing revenue at less than what they just grew revenue at. 16% is what they just grew revenue at. I am at 14% per year over the next 4 years, right? I am at a 16% net income growth, so getting a little leverage there, right? 33% net income margins come 2029. 27 to 32 PE would be very fair for a company growing. We can call it mid-teens revenue, mid-teens net income. 27 to 32 is very fair. That gives me about a 16 to 21% CAGR here for Google. Now, my base case has 12% revenues on average. This is what I actually expect to happen. 14% net income growth on average. 24 to 29 PE. 10% to 16% CAGR. Here's the thing with Google, okay? It's a good buy right now. But you're going to make way more money in Meta likely over the next 4 years. Like, it's as simple as that. Like, Google goodbye, more money's to be made in Meta. Like, in these companies are very similar in terms of how people view them. So at the end of the day, like, do you want to make more money or less money? You want to make more money over the next 4 years? Buy Meta. You want to make less money but still good money? Buy Google. It's up to you, right? Bear case for Meta here, or for Google here, 7% revenue growth on average, 8% net income growth on average, 20 to 25 PE, and basically we get a flat return to maybe slight growth. So the bottom line is, if things are bullish, I'm going to make more money in Meta. If things happen like I expect them to happen, I'm going to make more money in Meta than Google. And bear case, same exact thing. And that's why I have, $1 million plus in Meta stock, and I only have $100-something thousand in Google stock. Because at the end of the day, like, Meta is just going to be a way bigger moneymaker 2026 to 2029. And I don't even think there's really a debate about that, right? And remember, like, we're talking about Meta just grew revenues 26%. Google grew revenue 16%. 16% is very impressive. Like, how many companies are growing revenue 16%? Especially that are large companies. Very few. It shouldn't be like shunned. It should be appreciated. But they're getting whooped. Absolutely obliterated by Meta. Like, Meta 26, we're talking 1,000 basis points of revenue growth on Meta versus Google. Like, that's, incredible. Absolutely incredible. Next up here, Fubo. What's going on with Fubo? Where's that stock headed? Then we'll talk about some stocks I bought here today, and then Palantir, okay? So, the best news of the best news you could have gotten in regards to Fubo happened today. Disney closes deal merging Hulu Live TV with Fubo. This was a long anticipated deal. Took a while for it to finally get through the government and everything and all the loops there. Disney and Fubo announced closing of their deal merging Hulu Live TV operations with Fubo, with Disney owning 70% stake in the new company. The newly combined Fubo and Hulu Plus Live TV business creates the second largest virtual pay TV provider in the United States, with nearly 6 million subscribers in North America. That trails only Google's YouTube TV, which has an estimated more than 10 million paying subs, which is currently involved with carriage renewal fight with Disney, which is interesting. And man, you want to talk about making YouTube TV irrelevant, especially to sports fans? Take away ESPN. Ooh, boy. You want to see all of a sudden people flooding out of YouTube TV? Because remember, a huge component of the reason people are willing to pay for YouTube TV, Fubo, anything else like Hulu Plus Live TV is because of sports. Sports is huge, okay? Now, obviously they should figure out a deal there. Like, I don't think, ESPN wants to lose access to YouTube TV, but I'm just saying, like, they got a lot to stand on there. Disney and Fubo received clearance from the Justice Department's antitrust division to complete the transaction, according to two sources familiar with the matter. As part of the deal, Fubo Advertising Sales Group will move over to Disney's advertising sales organization. That could be a huge cost savings, and could also mean a lot better ads for Fubo moving forward. The companies emphasize that Fubo and Hulu Plus Live TV will continue to be available to consumers as separate and distinct services, each offering consumers multiple plan options from skinny to robust at compelling price points. In addition, Hulu Plus Live TV will continue to be streamed in the Hulu app and offered as part of the bundle with Hulu, Disney Plus, and ESPN Unlimited. Okay, very intriguing. The new company offers consumers more than 55,000 live sporting events and entertainment-focused programming offerings from Fubo and Hulu Plus Live TV. Remember, Fubo, the big reason you sign up for Fubo is sports, right? Like, I have Fubo personally. I've had Fubo for years, and it's a huge thing for sports, especially me because I like college football a lot, and Fubo allows you to watch 4 games all at once, choose whatever games you want. They've got just about everything you could possibly imagine in Fubo when it comes to college football and things like that. So sports fans is big with Fubo, right? As a deal closing, Disney holds approximately 70% interest in the newly combined company, with existing Fubo shareholders holding an approximate 30% interest. That's people like me, and if anybody else owns Fubo out there, you. The combined company will have access to a $145 million term loan that Disney has committed to provide Fubo in 2026 as part of the transaction. According to the companies, the merged Hulu Plus Live TV and Fubo business expects to realize cost, revenue, and operational synergies through content cost savings achieved by the more flexible programming packages, advertising optimization, and sales and marketing opportunities. So the moral of the story is cost basis, if anything, should come down significantly as a percent, right? Which means a lot more profitability. And Disney's very incentivized to have this service be, let's call it, very successful. And Disney owns a lot of assets, including they own ESPN, right? And guess what? ESPN now owns part of, or did they buy out NFL Network? I'm trying to remember. Did they buy NFL Network? Or did they buy part of NFL Network? And then if I recall, also ESPN now owns part of the NFL. They're now tied in with everybody. Like the tie-ins are like everything, right? Like Disney's played a masterful game of trying to control sports as much as possible, right? In terms of like controlling the content around that, right? And also you got to remember Disney's kind of at war with Google, right? And the reason being is, like, think about advertisers, right? They're both advertising giants, so they got to kind of fight over that. But also remember, like, if YouTube TV and Google's too successful, Google could buy a lot of exclusive rights over time. Like, for instance, a good example of this is the purchase of Sunday Ticket, right? And they purchased that out. They added that inside, exclusive deal there with their YouTube TV product. So keep in mind, Google's got a lot of money to spend. If they wanted to buy out certain NFL rights and only have those games on YouTube TV, they could, right? Same thing with basketball rights, baseball, Formula One, all these different things. So Disney has to fight off all these big dog tech companies that are competing. Amazon obviously has Thursday Night Football now. So it's a big battle there, right? And Disney's got to fight hard here. And so Disney's very incentivized to have this entity be as successful as possible. They're going to get more control there, right? And they don't want YouTube TV to be too successful at the end of the day, because that gives Google even more power to buy out more content rights over time, have exclusive programming on YouTube or through YouTube TV, all that good stuff, right? No, people were mad of the stock basically today because the stock didn't make a big move. And like, come on, man. Like, we got the big announcement. First off, okay, this had been rumored on X for days now at this point in time. So it wasn't like this was some, like, no one saw this coming. And everybody pretty much knew the deal was going to go through. Like, it was just a matter of time, right? And there was already rumors circulating all over X that this deal was going to go through this week, right? And so people bought call options thinking like Fubo stock was going to go to the moon and it was going to go $5, $6, $7, right? And, it's $3.69 here today. And so, people that were speculating on calls, listen, I saw the rumors out there as well this week that the deal was likely going to go through. Did you see me buy one call option contract on Fubo this week? Because I'm like, oh, shoot, the rumors are out there. The deal's going to go through this week. No, it's ridiculous. Like, I don't need to play gambling games, man. We're going to focus on the long here. We're going to focus on the big opportunity that Fubo has ahead. If Fubo is successful, it should be a $10, $20, $30, $40, $50 stock long term, right? And so I don't need to risk a bunch of my capital playing, the deal might go through this week and the stock's going to spike 30%. I'm not going to play that game, man. I'm not going to play that game. It's just too much stress, too much distraction. It kills your wealth if it doesn't play out that way, right? For something that, like, everybody knew the deal was going to go through. The big move happened when this whole announcement came out, which was, over a year ago now at this point in time? Fubo at that time was $1 something. If you were in the know at that time and, you made game-changing money, obviously, in the stock, right? But this, like, everybody knew that it was just a matter of time. And then the rumor had already, like, everybody that is aware of Fubo stock already heard that rumor on X days ago. So, to think, it's going to come out now and, like, the stock's going to go to $5, like, come on, man. Alrighty, next up here, 2 stocks I bought $7,000 plus of each. Let's get into that. First one, PayPal. Bought about $7,300 worth of PayPal here today, $69 and some change I paid for those PayPal shares. I spoke about PayPal very in depth on my reaction channel. My reaction channel is called Jerome Lefebvre Makes Money. I'm sure a lot of you guys follow me over there as well. And very, very excited about PayPal. Like, I'm the most excited about PayPal I've been since probably I invested in the company. I'll be honest with you guys. My entire investment time I've been invested in this company, this is the most excited I've been. Seeing the latest revenue growth numbers, seeing the partnerships they're starting to have all over the place, including the newest OpenAI deal, man, this is the most excited I have been for PayPal my entire time I've been investing in this stock. And it wasn't that long ago, even a few months ago, that I was kind of like, dang, even like 6 months ago, the revenue growth went down to 1%. I'm like, I might have just made a big mistake with PayPal. Like, it might not be the one, right? I might end up never making big money on this. I feel very differently today. I feel very confident PayPal's going to run to 150. And could the stock go back to 300 plus like it used to be years ago? If they could accelerate that revenue growth to double digits and keep it there for a few years, we'll see the stock back at $300. But they got to be able to pull that off. If they don't pull that off, maybe we can talk about a stock that maybe goes to 150. So I love PayPal. Once again, if you want to hear more in depth, I talked about SoFi, PayPal, and a lot of those stocks on the reaction channel last night. Okay, I think that was like a 56-minute video or something insane. Okay, next stock I bought today is, guess what? Cheesecake Factory. Over a $7,100 move here in regards to cake. Paid $50.05. Cake, I love it, man. I love it. I already spoke about cake in this video, so I don't want to go back into it. But the bottom line is I'm getting a dividend stock that pays me dividends every 3 months, trading at a value price that has insane growth engines underneath the company, like Flower Child growing revenues at 30+% clip, North Italia growing revenues at 16% clip, and I got the cash cow that is the Cheesecake Factory brand. Oh, and by the way, I got a bunch of restaurant concepts they're testing around the United States right now to see if those are the next big ones. Like, it's beautiful, man. Like, it's one of the best, in my opinion. If you're a long-term investor, it's one of the best stocks you can find in the market, right? I understand, like, everybody doesn't care about restaurants right now. The industry's down. AI, who's a chip company, Avago, AMD, nvidia. I understand everybody's, Palantir, the momentum. At the end of the day, we'll look back at the returns of the stock over the next 4 or 5 years, and I think we'll be pretty shocked that it's going to actually outperform significantly many of these high-flying tech stocks. Like, you'll watch Cheesecake from 2026 to 2029 significantly, in my opinion, outperform many of these super hyped, talked about tech stocks right now that everybody can't get enough of. And just watch. Little sleepy Cheesecake will outperform them all. And guess what? Except AMD. I don't know. AMD is the one I'm like, I don't know if they're going to outperform AMD, but probably just about the rest of them, right? And this isn't the first time this happened. Look at Texas Roadhouse stock. Texas Roadhouse stock went on an incredible 10-year run and actually outperformed not only the NASDAQ, but significantly outperformed many of the best tech companies in the world. Sleepy old Texas Roadhouse. Isn't that incredible, right? Sometimes these boring stocks, look at Costco's performance over the past 10, 15 years. Sometimes these sleepy stocks could be the best performers you ever imagined. And I'm sorry, but you got concepts growing 30+% revenues, 16% revenues. I don't think that's sleepy. I think those are very impressive numbers. Next up here, Palantir. So I posted this inside the breadcrumbs chat a little before market closed today. It was a video, a gladiator, and he's like gonna hit the guy, but then he just throws a sword down, right? And I said, it's me struggling so hard not to cash some more Palantir shares right here, right? Because I got 1,000 shares left in the public count. At the bottom line is, in regards to Palantir, I don't see the stock being a moneymaker 2026 to 2029. This is my base case for Palantir. 40% revenue growth goes down to 38%, 35%, 30%, 50% net income growth, 40%, 38%, 35%, right? 85 to 100 P, which is extremely high. Keep that in mind. Like, that's a 4x and even a 5x higher PE ratio than where the market trades at, right? And in that scenario, the stock's flat. I don't make any money. And that's at an 85 to 100 P ratio come 2029. I don't make any money. Like, Palantir's risk reward is just not there, in my personal opinion. The hype's there and the excitement's there, right? And the growth rates are there in the short term here, but it's just the numbers don't add up when you run it over the next few years. And I posted this on X. If you ever want to follow me on X, I always have that linked in the description area, all my videos. I said, PayPal will outperform Palantir significantly 2026 through 2029. Bookmark this post. Very controversial statement right now, right? But guess what? 3 years ago, it was extremely controversial for me to be buying Palantir stock. Almost no one believed in Palantir stock 3 years ago. The stock had crashed 70, 80%, and I stepped in. I'm like, I think this company's product's amazing. I think they're going to be able to grow this business immensely over the next 5, 10 years, right? And the rest is history. And so now I come out with a very controversial statement that PayPal is actually going to outperform Palantir significantly. And I think Palantir is going to be a flat or down stock 2026 to 2029, right? I'm pretty confident in that. When I say pretty confident, I think there's a 90% probability Palantir ends up as a flat stock or down stock 2026 to 2029, right? PayPal's not going to be. PayPal's going to be a huge moneymaker. I think PayPal likely 2026 to 2029. I think PayPal probably doubles or maybe even triples or quadruples up its share price over those years, right? I appreciate y'all for joining me. I hope you enjoyed this beast of video. Only thing I need from you is the thing hopefully you already did, and that's smash that like button, okay? If you want to apply, join Private Stock Group, Private Wealth Group, get access to 1000xstocks.com, all that good stuff. Pin comment down there. We'll send you your Steel membership cards to your house once you join us in there. There's a private group card. We have the Steel membership card for 1000x. We'll send you that as well. And then if you join us on a lifetime basis, we'll send you your Steel membership card for the lifetime. I keep that baby in the plastic because it's just too darn beautiful. Much love and have a great day.